Students, happy and good morning to you all. Thank God for the new day. I pray that God's grace be upon us and keep us all safe and protected during these difficult times. Students, take care of yourself and follow the instructions of your dear parents. Don't miss it. Students, I greet and welcome you all to the class on commercial applications. Continue to be committed to do your good work and stay focused and grasp the concepts with first-class fineness. Students, the learning objectives for today's class are as follows. We are into the chapter of joint stock companies. We are finished with partnership, which was pretty long. Now we are into joint stock companies. And in the previous class, I finished the features of joint stock companies. I think I've finished about 7 features of joint stock companies for you all. Uh, you all know the children. So 7 points I've finished. That is the features of joint stock company: registered body, separate legal entity, existence, then perpetual succession, limited liability, transferability of shares, common seal, and then separation of ownership and control. Now we are going to the 8th, 9th, and 10th features. So the first learning objective will be the features 8 onwards to 10. That is voluntary association, artificial legal person, and statutory regulation and control. Then we'll move on to studying distinction between partnership firm and joint stock companies. There are about 8 points. I've made it very simple and easy for you. You must know at least 7. Then we'll move on to the merits, advantages, benefits of joint stock companies. There are about 9. You can pick up 8 or 7. Let me list out it for you quickly. Merits of joint stock companies are as follows: large capital resources, limited liability, continuity of existence, efficient management, transferability of shares, capital formation, democratic management and control, goodwill and public confidence. So we'll move on to the first learning objective for today's, the 8th feature of joint stock companies. We have finished about 7. The 8th one is voluntary association. Students, stay focused and learn all that is said and done, children, please. Yes, thank you. So we move on to the 8th feature of joint stock companies, voluntary association. Students, please make a note. Voluntary is nothing but one's own free will. It is optional, discretionary, not compulsory. Anything which is not compulsory is voluntary in nature. So anything which is not compulsory is voluntary. Association, group of people joining together for a joint purpose or common purpose. So voluntary association. This is one of the important features of joint stock company. Company is an association of many persons, members, on a voluntary basis. That means what? Free will, optional, discretionary, without any compulsion. A private company may have minimum of 2 and maximum of 50 members, whereas a public company can have a minimum of 7 and a maximum limitless. So even in joint stock companies, you got categories: private company and public company. Children, quickly make a note. What do you mean by private company? Private companies are those joint stock companies whose shares are not given for public for sale. So it operates under legal requirements, children. So the shares which are not offered for public for sale is known as private company. If the shares are offered for public for sale, it is public company. So you must understand what is private. Private company are those company whose shares are not for public for sale. So you must understand that, children. Then members of a company can join it easily, freely, and leave it at their own free will. Own free will is nothing but voluntary. So you must quickly make a note. Voluntary is nothing but one's own free will. Association is group of people joining together for a joint purpose. And the members, I told you, in private company there are minimum 2, maximum 50, whereas in public company minimum 7 and maximum limitless. That limitless itself is a merit, children, because they can raise huge capital, because the maximum number of members are not given, so they can raise means a huge capital. 9th one, artificial legal person. Children, this is a very strange word. This is a legal term. Artificial is not human person. So in law, it is in a figurative sense, children, it's a legal term. Artificial legal person means, you must understand, business corporation is considered to be an artificial legal person in the eyes of law. So they consider organization as an artificial person, as a single entity. So it's a legal term. What is not human, what is not natural is called as artificial. A company is regarded by law as an artificial person. It's a legal term. Again, I'm telling artificial legal person is a legal term in figurative sense. Company has the right to acquire and dispose the property. They can acquire, they can purchase, and even sell the property. They've got the right because business entity with independent rights and liberty. and liabilities also. Company can enter into contract with the third parties, the outsiders, in its own name. It can sue. You know what's the meaning of sue, children? You can file a case and can be sued. Others can file a case against you. All this can happen in the own name, in the business entity's own name. So again, I'm telling you, what is artificial legal person? Artificial legal person means group of people acting as a single individual under law. When group of people act as single individual and they form an association, that becomes an organization, a company. So you must understand this, children. Here, what happens? Company is owned by shareholders and managed by directors. So you got a difference between owners and the managers. Who manages? Directors. Who are the directors? Directors are the elected members of the elected members by the shareholders. And who are the owners of the company? Shareholders. So you must understand, owners are different from managers. So artificial legal person is different from natural person. So this word artificial legal person is very much used in judicial terms, in legal terms. Next one is, 10th one is statutory regulation and control. Statutory, statutes, which is enacted by statutes, laws, enactments, acts, governmental statutes, all this come under statutory. This is nothing but a regulation and control according to the act and its provision. Which act companies, uh, joint stock companies come under? Indian Companies Act of 1956. So they have to obey the rules and regulations and the statutories of the government, since they are coming under the governance of Companies Act of 1956. Companies governed by the Companies Act of 1956, and it has to follow the various provisions of the act. It has to comply with the statutory requirements. What is the meaning of complying, children? You must act in accordance, you must obey the government rules and regulations. So they must act. It means organization. A company must act according to the statutes, according with the government rules and regulations, and with the statutory requirements. Accounts of the company, which is very important. Final accounts of the company must be audited. What's the meaning of auditing, children? Official financial inspection of the accounts of the company. So company's account will be officially inspected by a professionals called chartered accountants. These are highly qualified people, so they will verify the accounts, they will inspect the accounts, they will confirm the account that accounts are kept properly according to the principles and regulations, and also submit tax returns to the government. So these are the rules which has to be followed. What's the meaning of tax filing, submitting tax returns? Nothing but you must report about the income and expenditure of the finance of the company. You must report about the income and expenditure of the and any other financial information about the company to the government. So what is eighth feature? Voluntary association. The ninth one is artificial legal person, and the 10th one is statutory regulation and control. So we'll quickly move on to distinction between partnership firm and joint stock companies. Partnership firm and joint stock companies. So there are about 7 to 8 differences, children. Let me quickly go on with you. Partnership firm is governed by the Indian Partnership Act of 1932, whereas company is governed by the Companies Act of 1956. The first one is joint stock company is governed by the Act of 1956, whereas partnership is governed by the Act of Indian Partnership Act of 1932. The second one, in partnership firm, there is a minimum of 2 members and a maximum of 20. We can take 10 for banking in between. So 2 is the minimum, maximum is 20 for other business. Whereas in private company, private joint stock company, minimum 2 and maximum 50. And for public company, I told you, joint stock companies have got 2 sections. You got the private and the public. What is private? I told you, private joint stock companies are those companies who will not sell the shares to the public. If they sell, they become public company. So you can understand. Third one, partnership is created by an agreement, whereas company is created by law. What do you mean by agreement, children? It's a kind of an arrangement, binding between parties. They can do orally or they can do it in writing. So partnership is just created by an agreement when people come together, whereas company is created by law. Not only agreement, but also they must go through the formal procedure, legal procedure. Fourth one, in partnership, partner and this partnership are not separate entities. So they are one and the same. The partner and the partnership are one and the same. Whereas the company is separate from its members. I told you, who is the owner of the joint stock company? Shareholders. And who are the managers of the joint stock company? Directors. Who are the directors? Directors are the elected members elected by the shareholders. In partnership, registration is not compulsory. So you must understand it is not it is just voluntary, may or may not be registered. Partnership may or may not be registered, whereas registration of the company is compulsory. That is very important. Sixth one, in partnership, partners cannot transfer shares in the firm, whereas in public company shares are easily transferable. So you must understand, children, who can transfer the share? The shareholders. The shareholders called partners can transfer the shares in the firm, either by sale, gift, etc. What happens when they transfer the share? Please make a note, children. Transfer of ownership of shares takes place. So they become entitled. Whereas in the public shares, they are not transferable, children. They cannot, in a public company, they are easily transferable. Whereas in partnership, they are non-transferable. So what is the result of transferability of shares and non-transferability of shares? When you transfer, it is very beneficial for the partners in the joint stock company. Whereas in partnership, shares are not transferable. Partnership firm is managed by all partners, whereas company is managed by directors. I told you there's a difference between owners and the managers in a company. Whereas in partnership, it's all one and the same. Partnership can be formed or dissolved easily, whereas the formation as well as winding up means closing down, end of the company involves legal procedure. You cannot close down the company as you like. So what is the meaning of dissolving? Dissolving is nothing but closing down, ending the company, liquidating or winding up. So closing down the company, ending the company, liquidating the company, winding up of the company means dissolution. It can be done easily in partnership, but it cannot be easily done in the case of company. So let me summarize the 7 points for you once again, children. Please make a note. Partnership is governed by Indian Partnership Act of 1932. Joint stock company is governed by Indian Companies Act of 1956. Partnership, minimum 2 members, maximum 20 members. 10 in case of banking. In joint stock company, minimum 2, maximum 50. That's in private. In public, minimum 7, maximum limitless. That means maximum is limitless in companies. Third one, partnership is created by agreement. Company is created by law. Partners in partnership are not separate entities; they are one and the same in partnership. Whereas in company, it is separated by the members from the members. Partnership firm is not compulsory. Registration is not compulsory. Whereas registration for joint stock company is compulsory, becomes legally binding. Sixth one, partners cannot form means transfer the shares easily under partnership, whereas in company shares are easily transferable. It's benefiting the partners or the members. Seventh one, under partnership, partnership is managed by all partners, one and the same. Partners and partnership are not separated, they are one and the same. Whereas in joint stock company, it is managed by the directors and owned by the shareholders. I repeat, in case of company is managed by the directors elected by the shareholders, and whereas owned by shareholders who raise the capital. Eighth one, partnership firm is formed and dissolved easily. You can close down easily without any legal formalities. But whereas in company, formation and closure requires legal procedure. It takes a lot of time. There are about 7 to 8 points, student. You can take up any 7 or 6 maximum, and you must prepare. Students, owing to time slot, I'm going to take up the merits in the next session because they've asked me to do it within the time slot. So I'm going to take up the merits, advantages, and benefits of partnership firm in the next session. Until then, I wish you all to stay safe, protected, and motivated. Children, God bless us. Let us have a blessed days to come. Thank you. Thank you.